I looked at today were those 5-year out, 5-year forward break-evens. It's so different for the United States with a whiff of inflation versus the disinflation of Europe. What does that signal?
Well, I think that signals that Europe is in a very difficult situation in terms of the extent of the disinflationary, deflationary forces. I mean, we've had record low inflation prints recently, and I think that's going to prompt the ECB to implement more policy action, but probably not until the end of the year or early next year. Well, I think in the US, there is still a challenge on the inflation front, but I think there's more upside potential, particularly if we do get a substantive fiscal stimulus after the US elections.
Given that, David, do you think that the euro, the rally that we've seen versus the dollar is overdone?
Well, I think if we get a situation where, you were discussing before, a Democrat clean sweep, then I think market expectations will be for a very significant U.S. fiscal stimulus sometime in early 2021. I think it's going to be associated, at least initially, with a weaker dollar. I think you're right, Lisa. Does that play out with a stronger euro? I actually think it will benefit the sort of laggards of this recent dollar weakness, which has been emerging market currencies. I think a sort of Biden and Democratic clean sweep is unambiguously positive for emerging market assets, including currencies. So that's where I'd rather play, where I think we're going to see some future dollar weakness.
Is that just a trade policy trade, David? What is that?
Yeah, I do think that there is a sort of trade policy premium uncertainty associated with a Trump administration, and that extends not just to obviously relationships with China, but also the way that tariff policy is being used with a number of trading partners, including allies of the US as well. So I think if you take that out, that other things being equal, that implies a weaker dollar. And I think a big US fiscal stimulus package would also be then a sort of signal for the market to sort of more aggressively or decisively go into a rotation trade and a kind of global reflation trade. I think you get a steeper Treasury curve, but as part of that as well, I think you get some rotation from, dare I say, from growth to value, but also into, I think, some of those assets like emerging markets that do better in a sort of global reflation world.
Dare I say it, you said it, David, so let's discuss it. This rotation, the elusive rotation, this idea that banks can start doing well, that curves can start steepening. I mean, that's the European trade. That's the long right there. That's the trade everyone wants to see work and just hasn't for so long, David. If it worked in the United States, can it work in Europe?
Well, yeah, I mean, I think it can help. I think if we see that kind of move in the US and steeper curves, then to some extent that would sort of show the way for European policymakers. I mean, we have seen a better and more coherent policy response from European policymakers, particularly on the fiscal side in this crisis, than we've seen in previous crises. But I do think that as part of, in order to get that, make out that kind of Japanization story for Europe, we're going to need continued fiscal policy support. And I think the ECB is going to have to accommodate that by extending its asset purchases, by essentially saying we're going to backstop government borrowing and don't worry about how much debt there is right now. Keep on borrowing and keep on supporting the recovery. And I think if we get that as a story, not only in the US but also in Europe, then I think we will see steeper curves, and I think it will be beneficial for cyclicals and value like financials.
David, what's your hedge? What's your go-to asset to counteract if you're wrong about this reflation trade?
Yeah, I mean, it's actually not an easy thing to do, to find hedges for portfolios right now, because I think the way that fixed income has behaved, core government bonds, during September shows that it's become very asymmetric. I think it's hard for those yields to go much lower. And I think if we do get some positive news, incremental policy news, particularly on the fiscal side, but also in terms of, for example, a vaccine before year end, then I think those yields sort of move higher. How do you try to sort of mitigate that risk a little bit? I mean, we've reduced some of the risk within our portfolios given the level of uncertainty at the moment, but also you stick with your bias to sort of up in quality to sectors like utilities in high-grade credit.